Uber runs the biggest on-demand marketplace on Earth. Rides, food, freight, and it's finally minting cash. So why does the stock trade below almost every estimate of what it's worth? The market fears self-driving cars make Uber obsolete. But what if driverless cars actually need Uber? That's the fight we're settling today. Welcome to Wall Street Holics, research and education, not financial advice. Uber closed at $74.35 in early July. Let's dig in. Here's the verdict up front. Undervalued, but only medium confidence. Base case fair value is $103 against a $74.35 close. Blend the three scenarios. Bear $60, base $103, bull $140. Buy their odds, and you get a probability-weighted expected value of $102. Our headline number, 37% above today's price. Why the gap? The market prices Uber as if Robotaxis will cut it out of the loop. We think the opposite is at least as likely, and that one debate drives the entire spread. So what is Uber, really? Think of it as the switchboard for moving people and things, matching riders with drivers, diners with restaurants, shippers with truckers, and taking a cut of every booking. Extra money comes from ads and its Uber One membership, now 50 million strong, with nearly 200 million people opening the app monthly. The moat is the flywheel. More riders attract more drivers, wait times fall, prices drop, more riders pile in. A single city robotaxi fleet can't match that global liquidity, the heart of the bull case. This is the slide the whole stock hinges on. The bull view: driverless fleets need to stay busy, and on Uber, Waymo cars in Austin and Atlanta reportedly run about 30% more trips a day. Uber already has more than 20 autonomous partners, and driverless trips grew roughly tenfold in a year. The bear view: a scaled player like Tesla could build its own robotaxi app and bypass Uber, and Waymo just exited their Phoenix partnership, proving partners can walk. Our call sits in the middle, genuinely two-sided, which is why confidence is only medium. Now the engine. In 2025, Uber pushed $193 billion through its platform, turned that into $52 billion of revenue, up 18.5%, and generated $8.7 billion in adjusted profit. One flag: headline revenue growth looked like just 14% last quarter, but an accounting change knocked about 9 points off that optic. The truer gauges are bookings, up 25%, and free cash flow, the cash left after the bills, at $2.3 billion in the quarter. Ignore the flashy per-share earnings. They're inflated by one-off tax items. Is it actually cheap? On the metrics that matter, yes. You're paying about 15 times free cash flow for a business growing that cash flow in the mid to high teens. The PEG ratio, price weighed against growth, sits near 0.7, and under 1 is considered inexpensive. Free cash flow yield is a healthy 6.4%. Margins are rising, debt is modest, and returns on invested capital now clear Uber's roughly 10% cost of capital. So every dollar it deploys creates value. That earns a premium, not a discount. How big can this get? Uber's served market, ride-hail, delivery, digital freight, runs roughly $1.8 trillion, and its $193 billion of bookings is still a low single-digit slice. The runway has 4 levers. Uber One, driving people to order more often, a high-margin ad business past $1.5 billion a year, grocery and retail delivery scaling fast, and autonomy lowering cost per mile, which can expand the market itself. The signal is low penetration. Every thesis has risks, so let's rank them honestly. The critical one, though only a 20% chance, is that same debate. A scaled operator like Tesla launches its own app and cuts Uber out. More likely, robotaxi price wars or regulation squeeze Uber's roughly 30% take rate, the cut it keeps per ride. Then the mid-tier risks: gig worker reclassification raising driver costs, and a downturn softening spending on rides and takeout. Scale and membership cushion most, but autonomy is the one that can't be waved away. How do we get to $103? The backbone is a discounted cash flow model, projecting future cash and discounting it back to today's value. Take about $11.5 billion of free cash flow next year, grow it near 13% a year, discount at a 10% cost of capital, and you land around $103 a share. It hinges most on that discount rate. Nudge it, and the answer swings. But we don't lean on one method. Peer multiples and analyst consensus near $104, all cluster in the low 100s. 4 roads, 1 neighborhood. Now the scenarios, weighted by odds. The bear case, a 1 in 4 chance, sees a partner defect and a price war drag the stock to $60. The base case, a coin flip, has bookings compounding to $103. The bull, another 1 in 4, sees Uber cement its demand layer role and reach $140. Weighted together, $102, a positive expected value. But be honest about the spread, it hinges on one near-binary question, so you must stomach a slide toward the low 60s if the bear path wins. Let's put both cases side by side, fair and square. For the bull to reach $140, Uber becomes the aggregator of self-driving supply, turning robotaxi makers into interchangeable vendors, while ads, membership, and buybacks compound, and the multiple re-rates as autonomous vehicle fear fades. For the bear at $60, Tesla or another scaled owner launches its own low-price app, keeps its cars off Uber, more partners follow Waymo out, and price wars grind the take rate down. Both are serious, coherent stories, and which you believe is the whole ball game. So who's this for? Growth at a reasonable price investors with a multi-year horizon who can ride out volatility, because this debate resolves over years, not quarters. It's not for anyone who needs a calm chart or who's already sure Tesla and Waymo will own the customer outright. What to watch? Second quarter earnings on August 4th, Uber's progress toward its 15-city autonomous target, the pace of the $20 billion buyback, and, the big one for bears, whether Tesla scales its own robotaxi app in 2026 and 2027. Now, the trade. With the stock cheap and earnings weeks away, implied volatility, the market's bet on how much a stock will swing, is a moderate 35% and set to climb into the print, which favors selling premium. The headline play is a cash-secured put, seller put agreeing to buy Uber at $70 while pocketing the premium for an effective cost near $67 if assigned, a discount to $103 fair value. For pure upside, a January 2028 call gives leveraged, long-dated exposure. Covered calls, skip them. Capping gains this far below fair value makes no sense. And remember, options can lose their whole premium, so size small. Here's the whole thesis in 3 numbers. $62 is the floor, where the bear path bottoms, near the 52-week low. $103 is intrinsic value, where the cash flow model, peer multiples, and analyst consensus all agree. And $140 is the bull case if the demand layer story wins and the multiple re-rates. At $74, today's price sits below every estimate except that downside floor. This is where Uber lands on our scorecard, and it's the very first name in a new series. Close $74, expected value $102, upside 37%, verdict undervalued, confidence medium. Every future ticker appends right here. So over time, this becomes an at-a-glance league table of everything we cover, all scored the same way. Zooming out, long and mid-term, we're constructive. The platform compounds cash, while the market prices its autonomy upside at nearly zero. Short-term, it's choppy. The stock's about 27% off its highs and swinging on every autonomous vehicle headline. We score fundamentals a strong 8 out of 10, technicals a weak 4. The one trade we'd point to, sell that August $70 put to get paid while you wait, and own a quality compounder near $67 if assigned. Bottom line, the marketplace is cheap and the driverless future is basically free. So there's the case, a cash-generating platform trading below almost every fair value estimate, with genuinely uncertain but potentially huge autonomy upside thrown in nearly for free. Quick but important, this is research and education, not personalized advice. Estimates can be wrong, the data is current as of early July and will move, and options carry real risk of loss, so verify live numbers and consult a professional before acting. What we do differently is what you just watched. One repeatable process, honest medium confidence instead of fake certainty, and the bull and bear weighted equally. No hype thumbnails, no flip-flopping when price wobbles. If that's your speed, subscribe, like, and share this with someone weighing Uber. This is a subscriber-led channel. Requested tickers genuinely get made, so tell us who's next.
This video is for entertainment only, reflects the creator's opinions, may include stocks they own, and is not financial advice.